Okay, so we're officially live and it's going to take a few moments for everyone to join in the presentation. So we're going to take about a 30-second pause here before we officially dive in. Feel free to refresh your beverage and get ready for a little show here. All right, so I'm going to go ahead and kick us off now. First off, I want to extend a warm welcome to everyone that's joining us from the privacy of their home office or their actual place of work. We really appreciate you being here, and we're once again excited to share a little bit about what we're seeing going on in the Memphis market as a whole, and hopefully give everyone a little bit of an education as to what we're witnessing, seeing, and educating ourselves about as we want to pass that knowledge off to you guys. So my name is Brian Conlon. I'm in charge of business development with Meridian Properties. Also on the line here, we have my father and co-founder of Meridian, Kevin Conlon. We have the president of Meridian Pacific Properties, Kent Coykendall, and we have our client relationship manager, Jordan Varvel. So the intention of this webinar is to share about the current state of the Memphis single-family housing investment market. Between COVID, some laws that Trump is trying to pass, many people have had a lot of uncertainty through this time. And we're trying to give people a sense as to what we're seeing, what we're reading, and what we're hypothesizing will occur in the months to come in this particular investment space. The topics we're going to be covering specifically, let's see. We're going to start off with Kent Coykendall, who's going to be giving us an overview of the Memphis market, which is really going to be talking about how your investments right now are being impacted. Then we're going to be turning it to my father, Kevin, to talk about the SFR single-family residential investment outlook, both in Memphis and also nationally, to give people a bigger context or broader context as to what we're seeing out there. Thirdly, I'll be sharing a little bit about current opportunities for investors. I mean, whether it's refis, PPRs, or new investment properties, I want to share a little bit about what you all can do right now. And then finally, we're going to do a Q&A session that Jordan Varvel, our client relationship manager, will lead. So as we go through this presentation, you will notice, and I'm not sure if it's at the top or the bottom of your Zoom screen, but you have the option to type in a question. So throughout the presentation, if a question comes up for you at any point, please go ahead and type that question in. At the end, when we get through the slides, which we're thinking will be about 30 minutes or so, we'll then dedicate the rest of the session to answer any questions that you have. So without further ado, I will turn it over to Kent to give us an overview of the Memphis market. All right, good morning, Kent.
Yeah, thanks, Brian, and welcome to everyone, and good morning. So I want to give you just a broad sense of what's going on in Memphis, what's going on with our work in Memphis. But in general, the Memphis market is strong, and we're going to kind of walk through the elements of that. Kind of right now, everything kind of starts with what's happening with COVID. And, we saw a lot of spikes this summer across the country, and Mississippi and Tennessee were no exceptions. They got some, they started at a very low base, got some spikes. Everybody took it much more seriously. It's funny, I go out there 1 week a month, and you see the changes in people's behavior over month time lapses, and the awareness of COVID really went up this summer. Everybody wearing masks. But the good news is businesses are open, restaurants are open, and school is in, other than in the Memphis proper school district. So for the most part, things have gotten back to largely normal. People are managing COVID and doing their work, and a lot of that is because of the type of economy that they have there that we talk about often, the logistics and distribution economy. The business is booming. So COVID is not having a major impact right now. And kind of incredibly, Memphis, which has always been a central point for the civil rights movement and types of racial issues, protests have been virtually non-existent in Memphis. We hear about all the craziness all around the country. Memphis has not been part of that. And in fact, crime was down 5% in Memphis proper the first quarter of the year. And of course, like every other city, when the lockdowns happened and people were out of work, got thrown out of work, crime did go up, and Memphis was no exception. But relative to other cities, a 7 to 8% increase in crime has not been nearly as bad as many other cities. So very stable environment, relatively speaking, in Memphis, which is great. And I think that has a lot to do with just the steady employment base and the steady economy. How's that affected our rents? We've talked at each one of these webinars how our rents collections have been superlative. We've been above 99.5% throughout the pandemic. And this month, as of today, we're on schedule to be roughly the same. And we're going to talk about this in leasing a little bit, but a lot of factors go into that. It's the quality of our homes, type A homes, class A homes, the type of tenants, and the underwriting process, the tighter underwriting process that we go through, that really does get us a higher caliber of tenant and keeps our and the skills of our property management team really keep our collection rates high, and that's continued. One thing that was on everyone's radar nationally coming into August was, hey, is there going to be an eviction bubble? That's when the moratorium on evictions ran out through the CARES Act as of the end of July. That certainly didn't happen for us. We had less than a handful of evictions kind of tabled off to the side while the courts were not open. They reopened in Memphis. We've been moving forward on just a couple as required, but we just haven't had that issue. Now we hear this week that there is going to be a moratorium handed down through the CDC from the administration. There's going to be continuance of the moratorium through the end of December. We still don't think that that's going to have a material effect on our business or your investments in Memphis. Looking at the broader economic development, as I said, the economy in Memphis has remained strong, and their whole economic model has actually been validated through this pandemic, being based in distributional logistics and really supporting e-commerce. As everybody clamped down, as you know, everybody started buying online more and more. And a month does not go by in Memphis where we don't hear of another 1 million square foot distribution center, operations center, logistics center being built in Memphis. And more, we're hearing about those being built right near our developments around the perimeter of Memphis. Brian's going to talk about this a little bit more, but just an example, when I was there last month, literally driving down the street from our Horn Lake development, 1 million square foot distribution center by a Fortune 500 company was breaking ground, probably 300, 400, 500 jobs once we find out what it actually is. But that is happening all around the perimeter of Memphis, and that is where we are building our projects. Housing follows employment, and it's doing that, continues to do that now. Unemployment rate, Memphis has maintained about 2 percentage points below the national average, which is good. They virtually had full employment in the first quarter, and then of course COVID hit and it rocketed up to 13%. Now it's kind of leveled off at about 11% in the latest figures, and most of that is still related to hospitality and restaurants and other businesses that just have not been able to reopen. But in general, the economy is very strong. And another big trend that Kevin is actually going to speak more in more detail to is just the general trend towards single family housing. And we are seeing the benefit of that in our leasing activity, in rents. We're going to talk about that a little bit more, and Kevin will go into more of the reasons and the causes of that. So leasing, leasing traditionally has a very strong window from about March till the end of July, maybe early August. What we're seeing in Memphis right now is we're actually seeing a surge in leasing activity in August and September. A lot of frantic tenants filling out applications, looking for a place with great urgency, much more urgency than we have seen in the past. So a lot of the factors that are driving people towards single family homes in the suburbs are creating an urgency in prospective tenants that we have rarely seen. So leasing is strong, and our reputation as a quality, practical home builder, when I say practical, I mean homes that are built well for families to live in. Our reputation continues to build, and we continue to get the best tenants applying. And again, as I mentioned before, our strict underwriting is leading to higher quality tenants, which again helps us maintain our collection rates and maintain the quality of the homes from a maintenance perspective. Naturally, as we see that kind of demand, we're going to see rents start ticking up. We've got a chart, rents typically follow home prices. We're going to talk in a minute, kind of where home prices are going. But Brian, you can go to the next one that has the chart. This shows the 23-year steady increase in rents for 3-bedroom and 4-bedroom homes in the Memphis market. And you can see that there was, you can see, right at the tail, things are going to vary a little bit around the mean. But last year they kind of corrected down a little bit. This year they're going to head back up, in the neighborhood of 3, 4, 5%. And pricing of homes, if you switch to the next one, Brian, pricing of homes continue to be strong. And it's really a shocking statistic when you look at over the last 10 years. When you think of Memphis and Mid-South investments, you think of cash flow, you don't always think of appreciation. But the best kept secret about Memphis and some other markets is our appreciation has been very strong over the last 10 years with a 6.8% compounded annual growth rate since the bottom of 2011, which is only a couple of tenths of a percent below beautiful San Diego here, where you would think appreciation has surpassed most markets in the country by a long shot. The reality is, in the last 10 years, it's been relatively equal. So we're seeing continued strong growth in home prices. If you go to the next slide, Brian, you kind of just see the numbers. Right now, nationwide, there is a housing shortage. Kevin's going to talk about that. We've underbuilt for a long time. Nationwide, depending on the sector and the type of home, you'll see numbers anywhere from 5 to 9% in aggregate. Memphis, again, depending on the category and the source, we're seeing 7 to 11% increases. So it's well above the market average. And I think I just saw a recent list in the Wall Street Journal. Memphis was ranked 11th 11th in the country in terms of appreciation this year. But now all of a sudden there's a new shock to the system. So besides the normal strength in the market, the industry got hit with a bit of a shock over the last 30 days and really in the last 10 days. On this chart, you see, if you look over to the right, you see a big drop, and this scale is cost per board for 1,000 board feet. Right when COVID hit, you definitely saw a drop in prices of lumber for a couple of months. And then mills shut down. Mills had some logistical problems. Mills had some, it's a capital intensive business, but there are employees, and some employees got sick. Some railroad companies transporting lumber had some issues. Bottom line is prices went down, but now they have roared back. And a whole bunch of theories as to why that is, mostly around lower capacity and higher demand. And this is an unprecedented spike in lumber prices. Now, it's going to take a little time for the mills to ramp up their capacity. If they have to believe that the housing market, which has been strong, is going to stay strong. You look at all and Kevin's going to talk about this more, the housing market has been a bright spot in the economy. This is going to affect it in some ways, but this is also a temporary situation. As you can see by the chart, lumber is a commodity. It goes up and down with supply and demand. And when the supply is impacted and when the market is strong, you're going to see some changes in the price. But in the short term, we're looking at increased costs of about 6 to 10%. Lumber is about anywhere from 13 to 15% of the cost of building a home. So when that doubles in a 40-day period, that can't help but have an effect. So naturally, builders are going to be trying to increase their prices. And last week when this came out, every builder in the country was calling a timeout and contemplating their navel and their business and trying to figure out what they're going to do. And we were no exception. And we've come to a very clear conclusion that we are pressing forward with all of our projects. And the market, and as we'll see on the next slide, interest rates are going to keep things going along nicely. But we know price of homes will increase, and we know that rents will slowly follow. And with low interest rates, this is not only going to keep retail buyer market strong for homes, it's also going to keep investor returns healthy on new investments. And Brian's going to talk more about this in his presentation. So we're very confident that we can absorb that price increase on the lumber. Prices of homes are going to move up over the next 6 months to cover that. But with the low interest rates that have dropped, particularly for rental properties, it still makes it a very attractive investment. And if you have any existing investments, the refi market has vastly improved in the last 60 days, which Brian's going to speak to. So that's roughly the state of the Memphis market at this point. Kevin's going to get into more of the macro issues that are affecting this as well.
Okay, well, thank you, Kent. Yeah, it's exciting times. I'm going to be spending a few minutes talking about the state of the single-family market and what I see going on. I spend a lot of my time doing pretty in-depth research, from many different sources. I go to a lot of webinars and seminars around the country, industry conferences, and so on. So in the next couple minutes, I'm just going to try and give you the greatest hits, without going into too much of the underlying data, but enough to give you a good flavor for what's going on in real estate and why it's happening. One of the things we're seeing right now, as Kent alluded to, is that this investment product known as build to rent is the current star of the investment real estate market right now. Now, build to rent is exactly what we do. Okay, it's building a house intentionally for the purpose of renting it and selling it to an investor, as opposed to building it and selling it to a retail homeowner. We do some of that, but predominantly our business is selling to investors. Real estate's always been an attractive asset class, but right now, build to rent is the star, because retail, hospitality, office, and multifamily have all fallen. And the reason for that, obviously has to do with COVID, but each of those asset classes has one thing in common, and they all involve a high density living or working situation, which in the COVID era does not work really well. And so a lot of landlords have been struggling with these asset classes. We've been seeing prices of these assets declining, with the exception of multifamily. Multifamily's, hung in there, but it's just not growing, like build to rent is. Some forms of industrial real estate are doing decently at the moment as well. Okay. So if we look at some of the things that are driving, demand for this build for rent product, we have to go first and look at the, supply and demand imbalance, which has occurred over the last 10 years. Single family homes over the last 10 years have been, underbuilt. And if you look at the chart on the right side, if you look between 2006 and 2010, you see this precipitous decline that we slowly worked our way out of the last 10 years, but we basically created a hole. The population of the country continued to increase, during this time frame. But the filling the hole, we're trying to build out of this, and they are forecasting that over the next 10 years we are going to be undersupplied. We're just not going to build enough homes in the last 10 years to fill in the hole of the last 10 years. And most of the reason why we can't build faster is because there's a lack of well-located, developed land, basically availability of lots for builders. It's one of the reasons why we elected last year to form a joint venture so that we could develop land and create our own lots. And so that's how we've managed to address that problem. But a lot of builders are struggling finding lots. So that's constrained supply. Only about 6% of all of the new homes built are purpose-built for rent, but yet from an investment point of view, this is a very attractive asset class. Demand right now is greater than the current pace of production, and I'll talk next about what's causing some of that. Okay, Kent touched on this notion of suburban migration. Okay, so this is one of the the big themes in real estate investment right now on the residential side. We already saw suburban migration occurring as a result of millennials forming households, because the millennials are getting older. They're in their 20s and 30s, but over time they're going to be in their 30s and 40s. So they are forming households at a higher rate, and as one would expect, they're observing that the suburbs are a lot better for children and pets. Okay, so that had nothing to do with COVID. COVID, on the other hand, has really accelerated the suburban migration because single-family homes afford people more space. So people have not wanted to continue living in an urban environment where there are large numbers of people that they're around, or living in smaller spaces with other people and roommates and so forth. And a single-family home in the suburbs gives you that space. Also, COVID forced companies to allow their employees to work from home, something that many employers resisted for years. But COVID kind of forced the issue, and companies got used to people working remotely. They found a way to make it work. People got familiar with technologies like the one we're using in this webinar, Zoom, so that we can work remotely. And so in the suburbs, you have an opportunity to maybe convert a bedroom to an office, or have a purpose-built office in your home, and so forth. The suburbs are very affordable. The cost per square foot of buying a home in the suburbs is less than it is in the city. So a dollar goes farther, and the millennials are seeking that. And you might ask, well, why don't they buy instead of rent? Well, in some markets, like in the East and West Coast, it's because it's just cheaper to rent than it is to buy. But in a place like Memphis, it's less expensive to buy. But those who rent generally want the flexibility of renting. There's enough uncertainty about when they're going to have children, how many children they're going to have, whether they're going to stay working at the same company, whether they'll be allowed to continue to work remotely or not. And people want to have flexibility while they're living in a place they really want to live. So that's kind of what's going on. Kent also touched on the effect of interest rates. This chart shows what's happened with interest rates over the last 10 years. And as you can see, most of the last 10 years, interest rates were generally perceived to be quite reasonable, fluctuating between 3.5% and 5%. But now, owner-occupied mortgages are below 3%. That's never happened before. Even investor rates, which typically are a 0.5% to 0.75% more are still very low, and that has really juiced the investor returns. So investor demand has gone up and homeowner demand has gone up because of these low interest rates. And interest rates are forecast to remain on the low side for at least the next year. You know, and the Fed has been very clear about their interest rate policy, and they intend to keep rates low because it's going to take a while to dig out from under the hole that COVID created in the economy. Finally, I'd like to talk about another trend here, and that is appreciation of rural and suburban real estate. Interestingly enough, rural homes lead home price, have led the home price rebound mid-pandemic. Okay, and this is just testament to the fact that people are wanting to get out of the cities in places that are lower density, that have more space. Rural's been kind of off the charts. I mean, from July of last year to July of this year, rural homes appreciated over 11. And that's pretty significant, followed closely by suburban homes. And then we see urban homes overall appreciated year over year, but much less than those other two categories. So at Meridian, we've been paying attention to this particular trend because it's caused us to seek locations specifically, that can take advantage of this trend. And when we build rurally, it's not really rural in the sense that it's hundreds of miles from a city. I mean, we're still very close to Memphis, so I think you could call it quasi-rural. I mean, the homes look like regular suburbs. They're just a little farther out than most of the suburbs that we build in. Okay. So to summarize again, build for rent is right now the top performing sector in the real estate market. We're seeing a lot of generally high net worth investors investing in the space, a lot of private equity funds and real estate investment funds, real estate investment trusts. We're dealing with all of these categories of buyers right now. And again, this is happening because single family homes are still forecast to be undersupplied over the next 10 years. And demand is strong. So that's going to cause appreciation of both prices and rents. The suburban migration that has been in motion as the millennials have gotten older has been accelerated greatly by COVID as people have sought more space. Record low interest rates are driving demand because it lowers your monthly payments greatly, and offers great cash flow for investors. And as we just saw, rural and suburban single family have the highest appreciation rates of the three types of single family real estate, more than urban. So to give you a little more color on what we're doing in Meridian, I'd like to turn it back over to Brian, who will share with you what we're doing.
Awesome. No, I appreciated that. Yeah, so what I want to be talking about today is, as an investor, you might be thinking about, based on all these things that have transpired, I mean, what does that really mean for you, and what are the opportunities available for you? So I'll first start with looking at, now is a great time to refinance. I mean, as both my father and Kent shared, I mean, interest rates are really at an all-time low and are going to be there for the foreseeable future. So we're seeing that most investors right now, if they're to purchase or refinance a home, they're getting a rate between 3 3/8 and 4%, which has been unheard of since the time that I've really joined the Meridian team. And one thing I would invite you to consider is if you have an interest rate above 4.5%, based on what your goals and objectives are moving forward, it might be a good time to refinance. It might not. It really depends on how long that hold term is going to be for you and your particular objectives. The example that we put in here was showing what a 5% interest rate versus a 3 3/8 interest rate would do for an investor. So to me, this is pretty startling. I mean, we're only talking about a 1 and 5/8% difference in the interest rate, but it results in about a 60% bump in your cash flow if you're to go from 5% down to 3 and 3/8 on a 30-year fixed mortgage, which is pretty compelling if you find yourself in that situation. Another thing I might suggest is we've really had a strong run on appreciation the past several years. I mean, really this past year over year has just been incredibly high. And if you're looking at finding ways to pull out some equity or get some equity tax-free, a cash out refinance might be a great option. The rates are just a little bit higher than a conventional refinance, but not much. And I mean, the benefit is you get to pull out that equity and either redeploy it, keep it in your rainy day fund, but you can hold on to that money tax-free. Next thing I want to mention is that over the past several years, insurance rates have gone up considerably, specifically in the state of Mississippi as a Gulf state. So Nationwide, which is one of the preferred lenders that we are preferred mortgage brokers that we recommend to our investors, has really increased their prices over the past several years, and it's been a pain point that we've been very much aware of. So we've been working with our insurance broker to see what we can do to really mitigate those costs and not sacrifice any level of coverage. So fortunately, our insurance broker recently had a breakthrough, and they can now write for a company known as Travelers that offers strong premiums and coverage and for a much more affordable rate. I mean, for my Mississippi properties in general is about a 40% reduction in premium cost. The next thing that COVID has really impacted over the past year was something known as asset-based financing. So asset-based financing is really a commercial loan that you can use on a single family residence. So typically people use this loan when they are unable to qualify for conventional, Fannie Mae or Freddie Mac backed loan. So for instance, if you own a home in an LLC or a trust, or if you already have 10 conventional loans, which includes your primary residence, that's the max. Or if the borrower may be ineligible to qualify for conventional financing for whatever reason that might be, they are a great candidate for asset-based financing. I mean, this can be a great service to use, especially if you're in a pinch, like a 1031 exchange or something like that. These loan products disappeared entirely in the month of March, and it was actually about 2 weeks ago that they came back on the market. However, the rates are considerably higher than they were 6 months ago. When I say considerably, I mean about 1 to 2% higher than initially. So if you are an investor that's looking for that, you can probably get a rate that starts with a 5, but it isn't quite as strong as what you see in the Fannie or Freddie Mac backed world. So naturally, if you're interested in learning more about any of the things that I've mentioned, feel free to reach out to me and I can put you in touch with the right folks to help you out. Next thing I want to talk about is the portfolio performance report. So we've been talking about this in newsletters. A number of you have actually reached out. We've sat down and gone over your individual portfolio performance report. So what this report does is, when we first sell an investor a property, we show these really nice pro forma estimates, but then people may wonder, well, how did my home actually perform? So what this report does is, since 2014, we've been able to really track the actual returns for our investors. We've created this database that's pretty neat that actually allows us to spit out the returns for our individual investors. This report tracks your actual cap rate, your before tax cash flow, and your compound annual growth rate of your return, which really is a similar proxy to internal rate of return. In this report, you're looking at your cash flow, your debt pay down, and your property appreciation. The three different ways that you can make money in real estate. We're combining all of that information to really have it presentable for you at a glance. So if you haven't had this report done for you already, you're on a list and we'll get to you within the next several weeks. But if you want to prioritize that and get that done sooner rather than later, please reach out and we will prioritize that. All right, if you're in a position where you're thinking about adding on to your investor portfolio, I just want to talk briefly about the 2 different subdivisions that we are mostly involved in right now. So the first is a subdivision known as Nicole Place, which is in Horn Lake, Mississippi. And one of the things that we like about it, it is in the DeSoto County public school system, which just means that there's stronger schools than in many of the public school systems in the Memphis metro area. Additionally, there's a lot of employment centers that are popping up. Kent mentioned one where there's a mysterious, 1 million square foot facility that's going to be bringing a few hundred jobs to that area. In addition, Amazon, they already have a lot of centers around Memphis, but they just opened a new one a few miles away from this particular subdivision. And Google just launched its first US operations center here in the United States. So that's bringing another 350 jobs to the area. In this subdivision, the pricing starts at just below 200K, and we have inventory that's going to be available starting later this month. The next up, we have the Hedgerows subdivision, which is a suburb to the northeast of Memphis, just right outside of Oakland, Tennessee, in Somerville. What we like about that area is the property taxes are low. As my father mentioned, it's one of those quasi-rural areas that's seen a real strong uptick in leasing activity and also retail demand. And prices on those start a little bit higher at $255,000. And those homes are going to be officially completed starting in November of this year. Last time we met on this, we talked about some other subdivisions. So Ingram's Place is one that's opened up in a town called Byhalia, Mississippi, another place where there's a lot of jobs coming to that market. We did sell out of that first phase, but we do have a second phase that's going to be coming online starting the first part of next year. Additionally, we had a subdivision known as Fairway Hills, which is in Oakland, Tennessee, in one of those more quasi-rural areas. That's sold out, but the returns are nearly identical to what we have in Somerville. So if you were interested in one of those particular subdivisions, we have comparable products that are going to be coming out in the next several months. All right, well, that covers it for the current opportunities right now. I do want to turn it over to you, Jordan. I haven't been looking at the questions box, but I would have you share. If we have any questions, please lead us through that.
Yeah, I'm not currently seeing any questions. So if anyone has any, I invite you to head on over to the Q&A box, type your question, and we will address it.
Did we do that good? Did we answer every question? That would seem impressive. All right, well, we'll just give it a few seconds here. There's one that popped up.
Yeah, so Catherine is asking is this available for listening later?
Absolutely. We have this recorded and we're going to be adding it to our website. It should be officially launched, I would say, within the next week. And yeah, absolutely. We'll make sure John gets a chance to watch it as well. Let's see. I also saw one that popped up in the chat box. Thank you. Oh, Tim, it's an absolute pleasure, but I appreciate you being here.
Alrighty. Paul Sullivan asks, what did you say was the breakpoint interest rate for refinancing?
I mentioned 4.5%. I mean, really, if you're in the 4s or 5s, I would be happy to have a conversation with you. Because if you're thinking about selling the home within the next year, for instance, it may not make sense, even if your interest rate is at 5.5%, just based on what the closing costs could be for your particular investment. So feel free to give me a call if you want to have that discussion. We can kind of brainstorm about what would be the best, method for you and your particular situation. All right, any other questions that we can answer? And please know that you're welcome to reach out to me or anyone on this team at any point. We're happy to have a more direct conversation with you and provide any insight or wisdom that we can to really help you out with your investments. So with that being said, I'll just check with the panelists. Any closing remarks you want to put in before we wrap up?
Once again, I just want to express my appreciation to my other panelists here to, put on the webinar today. I appreciate putting this together, but I especially want to thank everyone for attending this. This is I know your time is pretty valuable. We're trying to provide useful content for you, and if you have any suggestions for content for our future webinars, we'll please make sure you get that feedback into Brian, and we'll make sure that that we try and touch on the things that you're most interested in hearing about.
Yeah, so, to that point, I'll include something in the next newsletter for people to give their feedback directly there in regards to the next webinar. So thanks for putting that in, Deb.
Okay.
All right.
Oh, awesome. Paul just reported that he was saving about $600 to $700 a year in premiums for the new insurance company. So that's awesome. So yeah, that's not unlike what I received as well. So really recommend that, especially if your insurance premium is over, I would say $800. Please check in with us or and we'll refer you to people that can help get that down for you. All right, anything else? All right, it's been an absolute pleasure. Thank you all so much for being here. And like I said, this will be launched on our website within the next week. And yeah, we look forward to talking to you all soon. Thank you again.
All right. Thank you.
Thanks,
Thank
Pam.
you.
Okay.
Bye-bye.